Okay, ladies and gentlemen, please take your seats. I hope you enjoyed your lunch. Well, it's very simple. Our next speaker is in a very select group of people that you can count probably on in one hand, who over the past 50 years has personally shaped the insurance world that we operate in today. I think quite simply he's a visionary. He's someone who can see into the future and anticipate changes in demand and structure in an industry. But of course the big difference between him and us, and maybe we can all sort of sit in the bar late at night envisioning the future of an industry, the difference between him and us is that he sees those things, then he works out what to do, and then he goes and executes on that. Because we all know thinking and talking, my job thinking and talking, that I'm good at that. But doing stuff, that's really, really hard. So in the mid-90s, he saw that the world would need a truly global broker, so he built one. Not everyone got that at the time. That was hard, but if it was easy, everyone would be doing it. And obviously, I'm sure everyone else wished that they'd had that vision and staying power, because the machine he built is a world-beating giant which produces eye-popping returns year after year and has a market cap that's bigger than almost all of the balance sheets it actually places business with. Many might have rested on their considerable laurels at that point, but he saw that the wholesale distribution was in need of consolidation. So he got on and he built a top-tier wholesale and specialty MGA group, which he's still building. He's still continuing to build. It's work in progress. So now, after almost 50 years of running the other way, our industry, in the past couple of years, our sector has suddenly rediscovered a taste for innovation and a new vision of a changed future for our own business. Or at least we're talking about it. In fact, we've had 2 Insurtech conferences in the last 12 months in this very building. So in such fervent and excitable times, I'm really fascinated to hear what he's got to say today. So please welcome Pat Ryan.
Thank you, Mark, and thank you, ladies and gentlemen. I was thinking about the 50 years, and not many said less than a handful. It's because they're not around anymore. I've outlasted them. But it's been a great 50 plus years in this industry, and I appreciate those comments about the vision. But there have been a lot of visionaries in this industry, and we have a lot currently. And I've been asked to speak about the impact of consolidation, and certainly this recent bit of consolidation gives us all pause to think about what that means. And I would say that the 3 principal CEOs involved in these recent deals are visionaries, because they're looking at the industry. I like the old Wayne Gretzky metaphor: skating to where the puck's going, not where the puck is. And I believe that AIG, Chubb, AXA XL, all are thinking about where the puck is going. So as I look at what this all means, and Mark asked me to talk about consolidation and structural change that will result from that, and then weave in the Insurtech, the technological impact on all of this. And I know that you had some earlier speakers talk about the consolidation, so I'll try not to repeat their focus, but I think it's really important to look at the why of these decisions by some of our really important leaders. And I think, frankly, and people are looking at it, well, like this is sort of an iterative process to take out Bermuda companies. Now, I don't look at it that way. I look at it as really, why are they doing it? Because Bermuda is just a location. I think it really is the emergence of what we would think of as a diversified, multiple capital platforms. So when you look at what AIG is getting with Validus, They already have a great U.S. business. They sold off a lot of their international business. They have a really good E&S business here in the U.S. But they're getting multiple platforms. They're getting Bermuda, they're getting London, they're getting expanded U.S. E&S, and they're getting a lot of talent and a lot of specialty lines. So they're expanding not just the scale, but they're expanding the scope dramatically of what they do. They're obviously getting the crop. They're getting back in the reinsurance business. So as you look at, there are multiple capital platforms. And I think that that's a really important way for us to focus on it. When you look at AXA, AXA left the U.S. in, I think, the early 90s. Didn't like the future of the market. And by their coming back, they're really addressing the multiple and diversified platforms because they're getting back into London, they're getting into Bermuda, but they're getting really importantly back into the U.S. property and casualty business. And they left the reinsurance underwriting business back around that same time, a little bit later, but now they're back in the reinsurance business. And then I look at the Chubb Ace deal, and Evan Greenberg. That wasn't a multi-platform, but that was a multi-dimension, specialty integration of really leading lines of business. So what did Ace get out of that? They got a very strong professional and surety business, both in the U.S. and internationally. They got that incredible high net worth personal lines business. They got a very strong U.S. mid-market commercial business. So you can see these multiple platforms. And so it's not just scale. It's really a lot of scope. So you're getting geography, where there's capital, Bermuda, London, U.S., E&S, U.S. admitted. And then, of course, you're also getting a lot of talent. And at the end of the day, all we have in this industry is talent. And in each one of these situations, they're picking up some really serious talent. So why do they do that beyond what I've just addressed? I think that we should look at the advantages of what a diversified multiple capital platforms do. Well, first of all, they increase the ability to diversify your product lines, and they're realizing that. And the ability to blend a lot of different kinds of risks, so that you've got low beta risks with more volatile risks. The ability to blend all of that. In a position, frankly, to get into the flow, because a lot of business does go to certain locations. The business goes into London, and you might not get it if you're just an EU company. And so being where the puck is going, where the business is going, I think is a critical factor. The opportunity to manage your capital in a much broader way. ILS funds, really, by being in the reinsurance business, being able to give clients multiple forms of capital on a single transaction. Treaty reinsurance, back, primary, fronting, with 50 state licenses. So the reinsurance gives them a lot of opportunity to be creative and develop new products. So as we look at what's happening in Bermuda, people are saying, well, who are the next Bermudians to fall? I really look at it like, who needs these multiple platforms? And then you can start saying, there are a lot of other international foreign companies that will look at this strategy and say, well, maybe we ought to be doing that. Now, people talk that Allianz was number 2 on that deal. I don't know. But I know they've been trying to get back into the P&C business in a major way in the U.S. And getting these multiple platforms could be quite attractive to them. and on and on. So there are other buyers with a lot of capital. I mean, the Japanese have been quite active. I mean, they've done a great job buying the HCC. And Tokyo Marine has got a lot of capital, so who knows? But I think it's a big statement about our insurance industry and about our currency when people with really big balance sheets from around the world are coming back into this market with their capital and saying that this is the place they have to be. So I look at that as being really, really very important. The last point I'll make on those acquisitions is each of the three survivors, went against their shareholders basically. When Brian Duperreault came into AIG, they were distributing capital back to their investors. That was the strategy. Brian said, "No, I want to grow. I want to build the franchise. I want to restore the franchise." So very audacious and bold. Certainly AXA, getting out of the life business, those investors thought they were getting all that cash from the life business sale. No, it's coming into the strategy that I just outlined. So, and then Evan made a brilliant move. Now his shareholders weren't pressuring him like the others, but still, the execution risk of M&A, people are afraid of. And if you ask most investors, do you want this company to grow through M&A, or do you want them to hone it down, drive up the cash flow, increase the return, the direct return through share buyback or cash, dividends? They'll take the latter. They don't want that. But these people are building franchises for the future. So I admire that. I think that it's the right thing. And, what we learn from that is that others are going to have to be looking at it the same way. Now, there are lots of opportunities for others to be doing that. And then, of course, what are the concerns anybody should have? Well, Evan has proved, Chubb has proved, Ace has proved, or New Chubb, that they could take those costs out. So it's not a matter of just being profligate and spending money, investing money. They're taking the costs out. And I believe that tight cost management control at AIG will prevail. And I assume that after what Excel and Catlin did, that they'll be able to do that same thing with AXA. So those are concerns, execution risk. But we're in the risk business. And if you only take what the market gives you in growth, you're not going to have a very robust future. So you have to take risk. You have to defy some of this conventional wisdom. I've always liked that because, I don't know, maybe I've been a contrarian most of my life, but I find that contrarians tend, if they think it through and are careful and thorough, tend to make that work better. So a little bit more about consolidation, because it's important to focus in on it. And I read the Insider today and said that Gallagher's got about $1 billion to be investing in M&A this year. And I've checked some of these facts out, and we look at all of it, who's buying what and how much are they spending, et cetera, et cetera. So you look at what Marsh has done. Marsh consolidating these regional mid-market brokers. It's just been a brilliant strategy. Aon, in their own way, had a brilliant strategy in terms of buying Hewitt and then taking the slow growth, low margin part of Hewitt and disposing of it for almost all what they paid for the whole Hewitt. So people are taking these risks and are executing and making 1 and 1 equal 3 or 4. So we see that with Marsh, and we see that now in the mid-market roll-ups. I mean, you probably heard this or read it, but there are very serious companies being created through that process. But I would say this, I think it's really important that people don't do deals just for scale. because you can't get the economic returns just doing a deal for scale. You have to improve the scope, whether it be geography, whether it be new product, whether it be new competencies, and there has to be revenue synergy opportunities to really make these multiples work. People are afraid of these very high multiples, and rightfully so. You can make them work, but you can't do it just by cost cutting, and you can't do it just by getting scale. So, just taking this through the last part of consolidation, Mark mentioned that we got into the wholesale broking business and the NGU business, and the last 7.5 years, that's been very good timing, and with that good timing has come a lot of opportunity, because there are a lot of sellers who are looking at these multiples and saying, if not now, when? Because they're really high. And so people are saying, I want to take some chips off the table, but I want to stay in the business. I want to help you grow it. And so the consolidation in the wholesale business, very much driven by the decisions of the retailers to use fewer wholesalers. That's been the wind at the back, as retailers have said, we're not going to use 200 anymore, we're going to use 4 or 10. So that's been a bonanza for ourselves, for Amwin, CRC, both of whom have been growing organically and through really good acquisition strategies. And then I'd like to touch briefly on the MGA, MGU business, because we're reading a lot about people setting up underwriting facilities, and it's a great business, but there are certain fundamentals that you have to have. And the first is, I believe, you really have to have a reason for being, not just because you can hire some underwriters and they've got a following. That's not a reason to go into business. You have to bring something that's differentiating. And that can be an expertise in the industry, expertise in product, but it can't be a commodity. The second thing is you have to be able to get critical mass, and unless you can get quickly to 40 million as a minimum of premium in a line, it's not going to work out. It's not going to be economically feasible, not going to have a stable business. So I say lots of opportunity in setting up underwriting facilities, but you really have to have the reasons for doing it be appropriate. So I want to talk briefly about the E&S business, because this is something that these acquisitions have gotten into, and it's clearly something that is really differentiating in this country, in this marketplace, and that is the E&S business is growing almost twice as fast as the admitted market. The E&S business, the percentage of the commercial premium was 20 years ago 6% and change, now 14.5%. So the E&S market's getting to be more and more important part of the overall commercial property and casualty market. And you heard about the complexity of the industry changing, the risks changing. As that complexity expands and the scale of risks expands, the E&S market becomes ever that much more important. So as these people have been looking at new platforms, the E&S platform is very much a part of what they're talking about. Now I want to get into technology, and let me say that we believe, and I'm happy to say that I'm seeing this as a basic thrust, that the future of the insurance broker and agent is what people are building their technology around. We don't think that it makes sense in the commercial lines insurance business. It can and does in personal lines. It makes sense to disintermediate the retail broker. The advice and the advocacy of the retail broker, I think, is permanent. And obviously I'm biased, but the $2 billion roughly that's going into Insurtech, the majority of that is not to disintermediate. The significant majority of that is to improve the experience of the insured. It's not a pleasant experience. Some people are even going back to the fundamental of providing other services in order to sell insurance in an Insurtech strategy. Well, I said, I'm old enough to remember when ARP was started. ARP now, providing services to seniors, that was started just to sell Medicare supplement insurance outside of Philadelphia. So, reverting back to the past. But the reality is, people are saying, what can we do to get costs out? What can we do to make the insured's experience a lot better? So, accessing a lot of public data, huge amount of money being put into accessing a lot of public data with artificial intelligence being the driver, and being able to underwrite with a lot fewer questions, being able to underwrite a lot more quickly, being able to get really the insurance company, the carrier, into a position of making really good decisions based on a lot of data that you might not even have in a traditional underwriting environment. So a lot of investment in artificial intelligence, a lot of investment in people getting in a position to make that experience so much better. You heard about the claims issue today. Lots of capital being invested to speed up the claims process, to make the claims process so much more transparent. These are all really good things for the industry. But most of this is focused, this investment is focused on the SME business. If you look at the personal lines business, GEICO has just replaced Allstate as number 2, and then very quickly Progressive replaced now Allstate's number 4. So you've got 2 direct response companies growing really fast. They're not going to catch State Farm for quite a while, but they're growing. But those policies are so much simpler than even a 10-employee or 5-employee commercial risk can be. And so, back to the agent and broker, that advice is critical. Some of the technology that's been built are asking the questions of the insured electronically, but they're not answering the insured's questions electronically or at all. And one I saw was at the end of, you take 20 minutes to go through the whole process. It says, if you have any questions, call Joe at this number. So I think that we've got the...
Pat, if you've got anything else to say, you're very welcome. You can ignore the clock. You've earned the right to ignore the clock, so keep going if there's one more point to make.
Well, I would say that... You want me to keep going?
Yes.
The question?
How long have you got?
No, I've run through all this. No, I'm ready to take questions, but I would just close by saying that there's a consolidation going on in the binding authority business. Binding authority is the base for the future of the SME business and the digitalization of that. And so we and others, many others, several others I should say, are buying binding authority businesses. The carriers have awakened to the fact that what was a local or regional strategy of carving out territory just is not the right thing for the insured or the right thing for the broker. So in the last couple of years, carriers have had to give 50 state authority on binding. That's the future. It's much better for the insured. It's much better for the carrier. That will be the basis for the digitalization of the SME business. All of us are working hard on getting to be the first mover in solving that one. We'll probably all get there at about the same time, and the competition will be good. But it'll be a major change in the SME business. So, questions?
Okay, well, Pat, the first one ties into what you were talking about at the end there. Does the advent of artificial intelligence and smart capital mean that brokers can take over the role of the traditional underwriter?
I don't think so. I think that there'll be the MGAs that get created, but the traditional underwriter, I think, is critical. When you get out of the binding authority size and scale, and complexity, you need the traditional underwriter. I don't think the broker is going to be the underwriter. I think the broker is going to be the advisor and the advocate.
Another technology kind of vision question. You've been the best of your generation at predicting and acting on new distribution trends. So what's getting you excited about today's insurance market?
Well, I just talked to a friend of mine who had a company in London that you use your cell phone and you get a quote and a policy issued in 7 minutes. But he said we sold that company. So, I think that there's a lot of technology that is designed to really shorten that. But that shortens the sequence of events. But I'm only talking about the commercial business. I think the commercial business will end up being electronically underwritten, but with the input of brokers and underwriters overseeing the electronic. I don't think that the carriers are going to just totally abandon their governance role.
The next question is what you can you mentioned about multiple platform strategy and those acquisitions with Chubb, AIG, AXA. Do you think there are still any missing parts of that multiple platform strategy for any of those, or the other potential acquirers, where anywhere in the domestic US that might be likely takeouts of that? Things they haven't got yet.
Well, I think the blending of capital markets with reinsurance. So there are some companies, and I'd rather not name them, who are really quite good at a lot of these things at international or even global companies, but more international, don't have those resources, who could become quite attractive. But to speculate on that would be not right for me to do.
Good. And another question here. We've heard a lot about scale and multiple platforms. Where do the small entrepreneurial firms or startups fit in and thrive in that vision of the future that you've got?
It's going to be difficult to be small in our business. It already is. Lots of wonderful wholesalers who didn't make the cut on the consolidation really have to sell. And they are. So the boutique, you can still be a boutique, but you can't be real small. And you have to be able to serve the brokerage community. And so a lot of people are merging for that reason. When you look at the M&A activity, there's a lot of private to private where they're saying, we don't want to be a part of any of these people that have approached us, so let's get together with some of our friends. We'll get some scale, we'll get some scope that way. But so it becomes you have to join into a larger enterprise. There are lots of ways to do that, but I think that's critical.
Right, we have come to the end of our allotted time, or a little bit over. So the next thing I'm going to do is I'm going to be handing over to you to Sebastian Kafetz, who's head of insurance at North America Lloyd's Bank. He's banked the London insurance business for 12 years straight out of college, and he's been here for at least 6 or 7 years, so huge amount of experience and someone who understands our industry extremely well. And he's going to be chairing our capital, M&A and financing panel, and I'll be handing over to him. But before we do that, I think we should give Pat another big round of applause.
Thank you. Thank you.